If you ask 1,000 different financial advisors, Wall Street gurus, and personal finance YouTubers what you should do with your money, 999 of them will give you the exact same answer. Just buy a low-cost S&P 500 index fund, set it on autopilot, and go live your life. It is considered the golden rule of investing. Warren Buffett recommends it. Your company's 401k plan enforces it, and if you argue against it, people look at you like you just insulted their religion. For the last 15 years, passive investing has been treated as financial holy water. It is supposed to be safe, diversified, and mathematically guaranteed to make you wealthy over time. But there is a fatal flaw in this system that nobody wants to talk about in 2026. A flaw that has quietly turned the safest investment strategy on earth into a massive, fragile, ticking time bomb. Welcome to the passive investing bubble. Today, we are going to look at how index funds actually work under the hood, why you are not nearly as diversified as you think you are, and what happens when millions of people blindly hand their money over to algorithms that do not care about price, value, or reality. To understand the trap, we have to understand how we got here. Decades ago, a man named Jack Bogle created Vanguard and launched the first index fund. His logic was brilliant and undeniable. He realized that most active Wall Street fund managers were basically just highly paid gamblers who consistently lost to the market average after charging massive fees. Bogle said, instead of trying to find the needle in the haystack, just buy the entire haystack. It was a beautiful, disruptive idea. Buy a little bit of every company in the S&P 500, charge almost zero in fees, and let the American economy do the heavy lifting. For a long time, it worked perfectly. But here is the problem with brilliant ideas in finance. When a strategy works, Wall Street packages it, sells it to the masses, and abuses it until it breaks. Today, passive investing is no longer the underdog. It has eaten the entire stock market. Trillions of dollars are sitting in ETFs and index funds. Every time you get paid, a chunk of your paycheck is automatically deducted and blindly shoved into the stock market through your retirement account. And that word, blindly, is the most dangerous word in economics. When you buy an S&P 500 index fund, a robot takes your money and buys shares of 500 companies. It does not read their earnings reports. It does not care if the CEO is a genius or a criminal. It does not care if the company makes billions in profit or is burning cash. And most importantly, it does not care about the price of the stock. If the stock is trading at 10 times its earnings, the robot buys it. If the stock is in a massive, euphoric bubble and trading at 200 times its earnings, the robot still buys it. There is absolutely zero price discovery. It is mindless, automatic buying. Now, if only 5% of the market is doing this, it is fine. The other 95% of active investors will do the research and keep prices rational. But in 2026, the active investors have been chased out of the building. The robots run the asylum. The majority of daily money flowing into the stock market is completely blind. But the trap goes much deeper than that, because of a mechanic called market cap weighting. Most people think that when they put $100 into an S&P 500 index fund, that money is divided equally. They think 20 cents goes to Apple, 20 cents goes to Ford, 20 cents goes to a grocery store chain, and so on. That is not how it works. The index is weighted by the size of the company. The bigger the company, the larger the percentage of your money it gets. Right now, the stock market is more top-heavy than it has been in a century. Thanks to the massive AI boom and tech monopolies, a tiny handful of companies, often called the Magnificent Seven, dominate the entire index. Apple, Microsoft, Nvidia, Google, Amazon, Meta, and Tesla. When you blindly buy the index today, you are not buying a highly diversified portfolio of 500 American businesses. You are taking a massive, concentrated gamble on a few tech giants and getting a tiny sprinkle of 493 other companies as a garnish. This creates a terrifying, self-fulfilling doom loop. As money blindly pours into index funds every 2 weeks from millions of retirement accounts, the algorithm is forced to buy more of the biggest companies. Because the algorithm buys more of them, their stock price goes up. Because their stock price goes up, their market cap gets bigger. And because their market cap gets bigger, the algorithm has to buy even more of them with your next paycheck. It is a momentum trade disguised as a safe, passive investment. The companies are not going up because their underlying business is fundamentally improving at that exact rate. They are going up because they are acting as a giant vacuum cleaner, sucking up all the blind liquidity in the financial system simply for being the biggest. Michael Burry, the famous investor who predicted the 2008 housing crash, warned us about this years ago. He compared the current index fund craze to the collateralized debt obligations that blew up the housing market. Back then, Wall Street took a bunch of garbage mortgages, packaged them together, slapped a AAA safe rating on the box, and sold it to the masses. Nobody looked inside the box to see what they were actually buying. They just trusted the label. Today, Wall Street takes wildly overpriced tech stocks, packages them with hundreds of other companies, slaps a safe diversified index label on the box, and sells it to your retirement account. Nobody is looking at the fundamental valuations anymore. They just trust the S&P 500 label. So what happens when this music finally stops? A market that only goes up because of blind, automatic buying will experience something horrific when it faces blind, automatic selling. Right now, the baby boomer generation is retiring at a record pace. For 40 years, they were in the accumulation phase, dumping money into these index funds. But now, they are in the distribution phase. They need to sell their stocks to pay for their living expenses, their medical bills, and their retirement. When a recession hits, or when a massive demographic shift forces people to start cashing out of their index funds, the exact same robotic algorithm that pumped the market up will be forced to sell. And remember, the robot doesn't care about price. It will blindly sell Apple, Nvidia, and Microsoft on the way down, driving the prices lower, which triggers more panic, which triggers more selling. In a normal market, active value investors would step in and buy the dip when stocks get cheap. But we have spent the last 15 years starving the active investors to death. The liquidity will dry up, and the exit door will suddenly look incredibly small. Passive investing is an amazing tool, but only when it is actually passive. Right now, it has become a crowded trade. You have been sold the illusion of diversification. But in reality, your financial future is tied to the success of about 6 tech CEOs and a massive money printer. This doesn't mean you should panic sell your 401k tomorrow and put all your money under a mattress, but it does mean you need to wake up and understand what you actually own. The era of blindly throwing money at an index fund and expecting guaranteed 12% annual returns is coming to an end. In the next decade, valuation will actually matter again. The price you pay for an asset will determine your reality. If you want to understand the mechanics of the market before the herd realizes the gates are locked, hit the subscribe button. I will keep reading the fine print so you don't have to. See you in the next one.